Ladies and gentlemen, good day, and welcome to Alivus Life Sciences Limited Q1FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star and zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Sumi Rao, Alivus Life Sciences Limited. Thank you, and over to you, ma'am.
Good morning, everyone. I welcome you all to the earnings call of Alivus Life Sciences Limited for the quarter ended June 30th, 2025. From Alivus Life Sciences, we have with us Dr. Yasir Rawji, our MD and CEO, and Mr. Tushar Mistry, our CFO. Our board has approved the results for the quarter ended June 30th, 2025. We have released the same to the stock exchanges and updated it on our website. Please note that the recording and transcript of this call will be available on the website of the company. Now I'd like to draw your attention to the fact that some of the information shared as part of this call, especially information with respect to our plans and strategies, may contain certain forward-looking statements that involve risks and uncertainties. These statements are based on current expectations, forecasts, and assumptions that are subject to risks which could cause actual results to differ materially from the statements depending upon the economic conditions, government policies, and other incidental factors. Such statements should not be regarded by recipients as a substitute of their own judgment. The company undertakes no obligation to update or revise any forward-looking statement. Our actual results may differ materially from those expressed in or implied by these forward-looking statements. With that, I invite Dr. Yasir Rawji to say a few words. Thank you, and over to you, Doctor.
Thank you, Shami. Good morning to everyone, and welcome to our first quarter earnings call. I appreciate you all joining us on early Saturday morning to discuss our results. Before we delve into the company's performance for the quarter, let me walk you through the broader industry landscape that is shaping our business environment. The global pharma industry is witnessing stable growth, supported by increasing global healthcare needs, a surge in chronic diseases, and advancements in biologics and personalized medicine. Regulatory bodies are also expediting approvals, particularly for critical therapies. At the same time, the industry is facing headwinds from pricing pressure, patent expiries, evolving compliance norms, and geopolitical risks. Strengthening supply chain resilience is becoming essential for long-term sustainability. With this, let me turn your attention to our performance for the quarter. We reported revenues of 602 crores, rupees 602 crores, which is a YOY growth of 2.2%. This was primarily driven by our non-GPL business, which grew 14.5% YOY and 4.1% QOQ, supported by successful new launches. However, this growth was offset by a 22% YOY decline in our GPL business, owing to inventory rationalization by GPL. This consequently impacted our generic API business, which saw a consolidated moderate growth of 3% YOY and degrowth of 7.1% QOQ. Geographically, regions like India, Europe, emerging markets, LATAM, and Japan contributed to the revenue growth. Moving on to our profits for the quarter, our gross margin for the quarter was 55.1%, up 400 basis points YOY, driven by rationalized input cost and leveraged operational efficiency. Our EBITDA margin for the quarter was 30.1%, up 210 basis points. Our EBITDA growth was 9.9% YOY. Our CDMO business remained subdued during the quarter. Validation batches for the fifth project have commenced. The commercialization is expected in H2. We anticipate a broader ramp-up across all CDMO projects during H2. I am pleased to share that our Dahej facility has received the EIR from the US FDA with an NAI classification following a routine inspection conducted from 26th to 30th of May of this year. I would also like to reiterate that our Ankleshwar facility received its EIR earlier this year after successfully concluding a routine GMP inspection in late January. Now, this has been a subject of discussion in many calls in the past, where our facilities had not been audited for almost 6 years, and in this last 6 months, we've had both our facilities, our large facilities, inspected by US FDA, and we've had successful outcomes of both those inspections. So, with respect to Sholapur facility is expected to begin in Q4 of this year. Our pipeline remains robust with over 569 DMF and CEP filings globally. As on June 30th, the high-potent API portfolio remains on the development path, with 26 products in the active grid, representing market size of 61 billion TAM, total addressable market. Of these, 9 products are validated, 3 products are in advanced stages of development, and the remaining 14 products are progressing through lab development stages. Looking ahead, we maintain our earlier guidance of mid-teens volume growth for FY26. However, due to pricing pressures, revenue growth is expected to remain in the high single digits. We anticipate stronger performance in the second half of the year, supported by a recovery in the GPL business and the ramp-up of all CDMO projects. We would like to reiterate that margins will continue to be in the 28 to 30% band in the foreseeable future. With this, I now turn the floor to our CFO, Tushar Mistry, who will walk you through a detailed financial performance for the quarter. Thank you.
Thank you, Dr. Yasir. Good morning, everyone. Welcome to our Q1FY26 earnings call. I would like to briefly touch upon the key performance highlights for the quarter ended 30th June 2025 before opening the floor for questions and answers. For Q1FY26, revenue from operations stood at 602 crores, a growth of 2.2% year-on-year. Gross profit for the quarter was at 332 crores, up 10.2% year-on-year. Gross margins for the quarter stood at 55.1%, which is well within our given guidance range. EBITDA for the quarter was at rupees 181 crores, up 9.9% year-on-year. EBITDA margin for the quarter was at 30.1%, up 210 basis points year-on-year, driven by better gross margins. This is on the higher side of our given guidance. Profit after tax for the quarter stood at 122 crores, with PAT margins coming at 20.2%. Chronic therapies contributed 70% to the top line in Q1FY26. CVS and CNS therapies continue to lead the growth during the quarter. R&D expenditure for Q1FY26 was at rupees 21 crores, which was 3.5% of our sales. On the balance sheet and cash flow movement, speaking of capital expenditure, CapEx for the quarter was rupees 52 crores. CapEx guidance, we have a CapEx approval from the board of rupees 600 crores, including carryover of rupees 190 crores from FY25. We continue to remain a net debt-free company, and I am happy to inform that we have generated strong cash flow from operations of rupees 100 crores in Q1FY26, with cash and cash equivalents of rupees 660 crores on the books as of 30th June 2025. In conclusion, we remain optimistic about our growth prospects, supported by strong demand trends, the addition of new capacity, and a robust order book. With that, let us open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets when asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Ahmed Madha from Unifi Capital. Please go ahead.
Yeah, thanks for the opportunity. Good morning, doctor. First, I have 3 questions. First, to start with, on Solapur, you mentioned around the Q4 timeline for the capex. How do you see the product filing from this facility coming up in the next year or so? And when can it sort of start contributing to the top line? Can you give broad guideline on the timing of over the next year or 2?
You want to finish all your questions? Or this is it?
Okay. Yeah, okay. This is first. Second, on the business mix between the Glenmark, non-Glenmark, you spoke about it coming back in second half. So I'm just trying to understand if when you're guiding for a high single-digit number for the full year, are you assuming the Glenmark business to be flat or slight decline? Because we haven't seen such a blip in last 8-10 quarters. So just to understand how you are thinking the growth rates between both these businesses, Glenmark, non-Glenmark. And lastly, very small question on the numbers side. So I see OpEx is up materially while top line growth is 2%. I think OpEx is up some 14%. Is there anything material to take note of? Yeah, that's it.
Okay. Sholapur will come online in Q4. We'll have to file products probably in the first half of next year to trigger inspections. But we do have a plan for Sholapur to do some ROW business. So it's not as if we'll capitalize and then, there won't be any business, done out of Sholapur. We plan to start ROW business from Sholapur in first half of next year. Coming to the GPL, non-GPL, I'm not sure what you meant by the blip here, okay? But look, the reality is that our business overall, right, is not a quarter-on-quarter business. Let's understand that, right? There is waviness in the demand pattern from GPL. We expect that GPL business will also grow, okay? And so we are pretty confident that, this high single-digit growth overall that we are forecasting is very likely to happen, okay? With respect to the OpEx going up, Tushar will take that.
Yeah, so there is no exceptional item on the OpEx front. In fact, it is in line with, if you look at our Q4 numbers also last year, it is in line with that. It's a normal growth that we have seen in our OpEx.
Okay. Thank you.
Thank you. The next question is from the line of Taran Agrawal from Old Bridge. Please go ahead.
Hi team. Good morning. So just a couple of things on your Glenmark business. I understand that we can't look at this business on a Q-on-Q basis, but overall, if overall on a year-on-year basis, if we were to see this business, last 2-3 years, we've seen this business not growing materially. So, is that the new normal, that this part of your portfolio, probably it's logical to see it growing at maybe 4-5% on a year-on-year basis? How should we look at this, the Glenmark business?
Tarang, it is lumpy, okay, and there is growth, and we've also, highlighted the fact that there is a contractual, obligation in place, okay, for that GPL business, okay. So we are pretty secure in that sense, right, due to that. But overall, they have a pretty good business globally, and we do supply, to GPL for their global market. So I'm not particularly concerned about this quarter being, lower than what we normally see, right? Coming to the entire year, it's difficult to say. But when we look at last year, it was okay, right? The GPL business grew, reasonably. Mid-single digits. So I think, it could be between mid to high single digits, but difficult to say, at this point.
Okay. The second question is on your pipeline. If I look at your HP API pipeline, it's been moving up reasonably well. I just wanted to see, given the last 2 years, the kind of investments that you've done in basically adding molecules to your grid, how are you seeing, them getting active in the front end? Have commercial supplies started for any of these molecules? And from a timeline perspective, is this the timeline that you had always baked in terms of these molecules coming to fore, or there has been a slight delay in terms of commercial activation of these molecules?
See, we have, of the 26 high potent products, right, 12 are already have got firm customer interest, and that's why we are validating. Okay, otherwise we wouldn't be validating in the plant. So there is firm customer interest, and this customer interest comes from across the geographies. Okay. So with respect to their commercialization, that all is timed by the patent expiries. So we should see commercial activity on our onco pipeline, on our high potent pipeline from late FY27. Okay, as the patents in some early markets start expiring. And then the remaining 14 products that are progressing in the lab, there is significant customer interest in those as well. But yeah, we've not generated R&D revenue from those as yet. But
Got it. So,
promising.
Got it. And I noticed that you're in advanced stages of adding one more iron sucrose molecule. If you could comment something on it?
Yeah, so that's going pretty well, right? We have another one about to get filed, an iron complex molecule, right? And we've got very significant customer interest for that as well. We've got a total of 3, but we are actively considering 2 more to put into the grid. So that's again a pipeline that will become pretty significant in the near future.
Okay. And from a FY26 vantage, how are you looking at CapEx, sir?
So CapEx, see, Tarang, there is a overflow from last year of 190 crores, right? And we hope to start our R&D project, this year as well. So that plus Sholapur coming to completion, as well as 2 big brownfield projects, both in Ankleshwar and Dahej, also have to complete. So when you put it all together, we expect to, spend about 600 crore with the 190 overflow.
Got it. So that plan remains, this is what you have communicated in Q4 as well. So that is status quo. That remains FY26, correct?
That's right.
Perfect. Okay. Thank you, sir. All the best.
Sure. Thank you.
Thank you. Participants who wish to ask questions may press star and 1 at this time. The next question is from the line of Bala Murali Krishna from Oman Investment Advisors. Please go ahead.
Hi, good morning, Ashwin. So in case of CDMO, even if the project is commercialized, so what kind of run rate we can expect? I think maybe we can hit 50 crores per quarter. Is it estimate is correct, or is there any chance for further room?
Could you please come closer to the mic and repeat your question, Bala?
Yeah, sure. Just a minute. So I'm asking about particularly about CDMO business. So now we have 4 projects running, and we are at average of 40 crores run rate every quarter. So even if the project is commercialized, so by that time maybe we can have a numbers like 50 crores per quarter, or there is some more room also for improvement. And any other, do you expect any other projects to commercialize in this year after 5th project?
Okay, so we have another 2 projects that are in the pipeline, but these 5 projects by H2 should all be commercial. Okay, and with regard to whether we will clock 50 CR per quarter, that's a very strong possibility.
Okay. So regarding capacity addition, so this year we are going to add around 40% by the March end. So it's the revenue potential is proportional to the capacity addition, or like reactor capacity addition, or do we see any incremental revenue as compared to current capacity?
See, not immediately, okay, because Sholapur is starting off. That will be a large capacity, but a good portion of that capacity is for backward integration. But like I said earlier, that we are going to start ROW business, or rather move ROW business to Sholapur. So yes, Sholapur will contribute to revenue, but it obviously won't be at the level that, we get on a per kiloliter from, let's say, Ankleshwar or from Dahej for that matter. So, I mean, it'll kick in, but it'll take some time to bring it to the same level. Okay. So we do expect that our FATR will drop a little bit, right? But that's okay. That's a very normal thing, right?
Okay. But this Ankleshwar and Dahej 260 KL will contribute to the same level, or it is also it is not a backward integration.
No. Ankleshwar and Dahej is not backward integration. See, Dahej is largely being done to facilitate our fourth project on CDMO, because that demand is going up very quickly. Okay. So we hope to be able to complete Dahej in time to be able to facilitate that business. Okay. Ankleshwar has got so many products, and like we said in our communication that we do have launches. We did have launches in the last 2 quarters, and we do have upcoming new molecules that we'll have to service. So Ankleshwar is largely for that. But yes, in terms of revenue, we expect revenue should come through.
So lastly, sir, I understood that next year you were adding for a high single digit, but all this in FY27, if all this capacities are running, so what kind of numbers you may be expecting in FY27, 28, incremental to FY26?
You asked for FY26?
27, 28.
27, 28.
27, yes, sir.
I think we'll at least maintain that, at least. Okay, there is upside potential. Okay, because like I said, a lot of the pipeline is maturing in FY27, 28. I even said even on Onco, right? Onco will start giving us in the second half of FY27. We'll start seeing even our Onco pipeline, going commercial.
Okay, that's something.
Thank you. Participants who wish to ask questions may press star and 1 at this time. The next question is from the line of Bharat Sheth from Quest Investment Advisors Private Limited. Please go ahead.
Hi, good morning, sir, and thanks for the opportunity. Sir, if we have to think from, say, 5 years perspective, like CDMO is a bigger opportunity in emerging. So how do we plan to, one is that you are doing physical capex that will help us in giving a more sustainable supply to the customer, but developing a pipeline and second thing on investment in developing a new capability like ADC or biotech, and third on the process efficiency for flow chemistry investment. So how should we think, and when do you think we are, and how is the second thing is our acceptance and as a CRDMO player by our customer?
Okay, let me go step by step. Okay, so
Correct.
Let's talk about CDMO 5 years, right?
Okay.
I mean, we will be a very credible player in the CDMO space in 5 years. Simply because we are already seeing that momentum. I just mentioned that apart from these 5 commercial projects, we have 2 now in active, discussion, and very likely that we will get those 2 projects. Okay, so if we keep that kind of hit rate, right, then we are talking of a pretty significant number of projects in 5 years' time. Okay. Now, with respect to ADC, biotech, these are all good things, right? And right, but we feel that the chemistry platform is something that will give us a faster payback, right, on our investment if we continue to stay with the chemistry platform. Okay, and leverage that, to build an even bigger portfolio, right? Now, this again has a benefit for our CDMO business as well. Okay, we don't anticipate getting into any kind of biologic platform at this point, okay? Because the number of opportunities that are available on the chemistry side are also very significant. Coming to flow chemistry, we've had some very good, in fact, one of our flow chemistry projects is now commercial, and we've made a huge impact in terms of cost, okay? And so our confidence level in leveraging flow chemistry is very high. We currently have 3 projects that are in the pipeline in flow chemistry. Now, what this does is that it gives us a very strong position in some key molecules, okay? And it will impact our bottom line, very significantly. And as we gain more market share because of our cost position, we are likely to impact top line as well. So the thrust will be in flow chemistry, right? And that would just continue.
Okay. So what kind of, investment that may require, again, building a normal, process chemistry vis-a-vis flow chemistry, and how do we, for next 3 years, we have a strategy to invest?
So the good news, Bharat, is that in flow chemistry, right, the investment typically is about 1/3 of what we do in batch. Okay.
Okay.
So again, the payback on that investment is also very quick. Okay. This is the experience. Now I'm saying 1/3, but it could be even half, depending 50%. But I don't expect it to be more than 50% of a batch, on the commercial side. In R&D, we have to make investments, but then those are small. And then once you made the investment in R&D and build a broad platform for flow chemistry, equipment, then that keeps getting used for newer projects as well.
Okay.
So it's investment light also. It's not investment heavy, flow chemistry.
Okay. So when do we see at the end of the 3rd year now, since he is so a kind of a benefit that you expect, maybe a broader contour if you can give, that is one. And second, now with backward integration of Solapur, what kind of benefit that we expect in 27?
So like I said, right, it would be initially a bottom line improvement because of backward integration and because of the use of this technology, okay? But top line benefit would take a little longer to come as we, gain more and more market share. So that's where we believe that, we'll get benefited. In 3 years, definitely, we'll see a very significant benefit.
Okay. And last question, if you...
Sorry to interrupt. Sorry to interrupt, Mr. Bharat. May we request you return to the question queue for a follow-up question? Thank you. The next question is from the line of Nitin Agarwal from DAM Capital. Please go ahead.
Doctor, good morning. It's been about almost a year and a half now since the ownership change happened. You've had time to really think through how you're looking to grow the business and the opportunities which have been there. Is there, while you've been communicating the same, since for the last few quarters, but is there any, any dramatic course changes, any improved opportunity spaces that you're beginning to see that can impact our business as we go forward? Is there any? What I really mean to ask is there a major difference in the way you're looking at the business as we were probably 6 months back in terms of opportunities?
Definitely, Nitin. Look, we spoke about this, but the thing is, we've got to look at different things and many things before we make a jump right into something, because then we are committed to that. So we've been evaluating quite a few things, and our net cash position is pretty strong. So you can expect that we would be making some very deep plays depending on our evaluation and how we move forward. It takes a little bit of time because again I said the one thing that you've got to understand about Alivus, right, is that we've got a very deep pipeline. 165 very good molecules, right, and we're seeing the sort of with the launches, the kind of response that we are getting, right, And we want to be able to not leave that as is, but in fact use that pipeline that we built over these last 5-6 years to leverage other things, right? I referred to CDMO as one area, but that's only one area, okay? So we are in the process of evaluating what we need to get into, apart from what we already do, right? So, it's work in progress, right? I can't say much more,
Okay. And now, just really trying to put some quantification around with whatever the way you're thinking. Two things. One is, how big do you think CDMO gets as a business for you in 5 years, 3 to 5 years, as a proportion of business?
So, if you recall, right, we had said that today it's about 6-7%, but we'll take it to around 12 to 15%, right, in 4 to 5 years' time. And again, that confidence level is very high because we are seeing more and more projects getting added, right, and the potential is pretty strong, right, both in life cycle as well as specialty.
Okay. And on the non-CDMO part of the business, I think this is the business where, relatively speaking, you had more, CDMO is lumpy, and once the contracts are signed, we know it's going to take off. But the non-CDMO part of the business, most of the peers also have been struggling with, the generic API growth in general. Structurally, is this a double-digit growth business, or this is a late single-digit growth business on a more sustained basis? How should we think about this business?
With our pipeline, it's definitely double-digit in the future.
Okay.
Now, of course, there's the GPL element, right? And they don't have that many launches as we are seeing in other markets and with our non-GPL business. But that's okay, right? We did the seeding, we did the work. That work continues in terms of seeding, right? And so, and we're seeing that already. You've seen the last 3 quarters now, Q3, Q4 last year, plus this year, we've had a good number of new introductions, okay, into the various geographies. So API business with us is, again, due to a fairly deep pipeline and a good geographic spread, is likely to continue, right, pretty strong.
So, just to recap, obviously, CDMO will take its own course as the contracts get signed up. And I presume with the confidence that you are indicating, the scale and size of some of these newer contracts should probably begin to inch up as we go forward, right?
Yes.
And you still believe that API, despite the GNP sort of scale down, scale up that keeps happening, it's a double-digit growth business on a sustained basis for us, at least for the foreseeable future.
Yeah.
Okay. Thank you. And margin should be in the same 28-30% bracket around it. That's the model that we should continue.
We lost PLI, right? But we are still delivering those margins. So, that should give you some idea, right, in terms of basically the strength as well as the sustainability.
The quality of this.
Yeah.
Fine. Thank you so much. Best of luck.
Sure. Thanks, Nitin.
Thank you. The next question is from the line of Avnish Barman from Vaikarya. Please go ahead.
Yeah, hi. Good morning, team. Just one very quick question from my side. I just wanted a little bit color on the CDMO business. Doctor, you mentioned in the last call that it's more of a life cycle management business. Can you just talk a little bit more about that? Are all your customers innovators? And when you say life cycle management, are they approaching you more for cost reduction, or are they approaching you when the patents have expired? Just a little bit more color on that side, please.
Sure. So, yeah, you're right. In life cycle, the cost reduction element plays a big role, okay? And obviously, we've got to, demonstrate sustainability as well, because typically these life cycle management projects come from the innovator who is moving from an in-house API to a different API. So, that element is important. Cost is important. Sustainability is important. I think we've proven that to our customers. Project 4, Project 5 are both life cycle projects, and they are significant in terms of their value, right? But like I said, there are 2 more active projects that we are discussing, and those are specialty and life cycle. So we are seeing reasonable traction even on the specialty side. Okay. The good thing about specialty is they do get a period of exclusivity, right? And so margins can be very good, okay, in that space. But we are open to both. The thing with specialty is that we need to do a fair amount of optimization on the molecule. Okay. Whether it's polymorph, whether it's a salt, whether it's a certain very narrow particle size range to, help the formulator. So there are all kinds of nuances that have to be built into the API in order to facilitate, a good, formulation that is being targeted.
Okay. And typically, the innovator takes decisions from moving from in-source to, let's say, a CDMO partner is when the patent expires, or there could be other reasons also?
See, that depends on how conservative they are, right? I mean, like we have this Japanese innovator, this is project number 5, you know about this, right? That they took that call only after the patent expired, right? But then there are other innovators who come in earlier and sort of want to be ready with the variation approvals, site additions and stuff, right? Just before generic launch.
Makes sense. Last question on the API side, if you can just give a little bit color on the product concentration. I mean, top 5 products would be what percentage of the revenue?
35. I'm making a guess, an educated guess. Okay, we're not very dependent. I mean,
no, I just wanted a ballpark figure. That's fine. It works. Thank you so much.
Thank you. The next question is from the line of Tarang Agrawal from Old Bridge. Please go ahead.
Hi, good morning. Just to follow up, you made a comment in your initial address that the gross margin expansion is a function of lower pricing of raw materials and at the same time some operational efficiencies getting created. So if you could just elaborate a little bit more on that. And second, it does seem like there is pressure in the API market, but simultaneously the pricing in the intermediates and raw material market is also very favorable for you. So does that mean that you're deploying more to corner more inventory? How are you looking at it?
I think, Tarang, you answered your own question, really. So there is a benefit, okay, on the raw material side, but it doesn't all come from there. Like we said, right, we've had launches, very good margins on the launches, right? Okay. And operationally also, we've been working on newer infrastructure. All that is now kicking in terms of better energy efficiency, better realization on second-gen processes and so on, right? So all this has come together, right? And that's why we were able to see, 55% gross margins, right, as a result of...
Got it. And second, when we see the non-GPL business growing by 14%, that would have probably been a function of almost 20-25% volume growth in that business, correct? Would that be the right way to look at it?
It's actually 18% volume growth.
In the non-GPL business, is it?
Yeah. So there hasn't been that much erosion.
Okay. Would it be because of the market dynamics or would it be because of you having launched new products?
Mix.
Okay. Got it. Super. Thank you.
Sure.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Ketan Chheda and retail investor. Please go ahead.
Yeah, hi. Good morning. Thank you for the opportunity. Doctor, you've talked about how upbeat you are about the CDMO business, and you also mentioned that on a sustained basis we can be a double-digit growing business as well. So from a slightly mid to longer term perspective, say 5 years out, I just want to get a sense not really a guidance, but a probabilistic scenario, that is there a possibility that we can probably cross 1,000 crore mark on a net profit basis, say 5 or 6 years out? Is that a possibility?
On a consolidated level?
Yes, yes.
Yeah, I think so. I mean,
Where was it? CDM.
CDMO alone. Are you
No, on an overall basis, total.
Consol, yeah, we're already 700 plus, right? I mean, yeah, comfortably, I think we can do it. Not a problem. I mean, look again, right, Ketan, we are focused on the pipeline, okay? It's a pipeline that addresses global market needs, okay? And then there is a level of value addition that we are bringing, okay, through CDMO, and there are other things that we are also looking at to create further value on the pipeline that we have. So I'm pretty confident that we'll be able to achieve that. I'm not giving guidance, okay? Like you said, you're not asking.
No, yeah, I'm not asking for guidance, yeah, but just a probabilistic scenario, yeah.
I mean, this is for you as well as for everyone else on the call.
Sure, absolutely, yeah. And just one clarification, you mentioned some figure about net profit. I didn't get that right. I mean, March 25 net profit, what I see is that we are about 486, 485 kind of net profit. You said 700 or something?
EBITDA.
Did I hear that right?
EBITDA, not the profit.
No, I was talking about net profit. Sorry, when I asked for the 1,000 crore number, I was saying from a net profit basis, not EBITDA.
Like double in 5 years.
Kind of, yeah, approximately, yes.
Well, we could be close, but let's see.
Okay, sure. And the other question I had is, in the past calls you mentioned about something like, you're probably looking at some new avenues, and you alluded to that in some commentary a few minutes ago as well. Is there a possibility that we could also do some kind of an acquisition of a company where we see a lot of potential, because I think our balance sheet probably could support that. Is that a possibility?
Yeah, inorganic is definitely on the table.
Okay. All right. Thank you, doctor. Wish you all the best.
Thank you.
Thank you. Participants who wish to ask questions may press star and one at this time. The next question is from the line of Alankar Garude from Kotak Institutional Equities. Please go ahead.
Hi, good morning, everyone. So you mentioned about commercial launches for the high-potent API segment starting from late FY27.
Yeah.
Similarly, can you comment on the broad timeline of the one filed ion complex and the two in advanced stages of development?
Alankar, one is being reviewed, okay? I mean, one is under review. But with these molecules, right, there's a lot of back and forth that both the ANDA player and us are sort of right now addressing, okay, with FDA. So, I mean, on the optimistic side, I would say 6 months, right? But it could even go beyond that. I mean, there's a lot of characterization work that FDA comes back and asks for. Okay. Similarly, when I said the other two projects are also moving pretty in a good, direction, the customer interest here is very high. Okay. Again, it relates to, the API characteristics. So while, there are different APIs out there, right? Our API in both these projects is in early formulation development work is extremely amenable for the right kind of formulation in terms of bioequivalence. Okay, I mean, at the end of the day, it's all about bioequivalence that US FDA cares about. So, and obviously you have to demonstrate that, right? So here, the traction is good. As far as approvals go, it's basically when the agency comes back and says, okay, you're approved, right? But again, like I said, it's both the ANDA players and us that are working simultaneously to satisfy the queries raised by US FDA.
Got it, sir. The second question, when you say inorganic is definitely on the table, Can you elaborate on this? Which areas are you looking at? Is it more on the capability side and less on the capacity side? Any color on that would be helpful, sir.
Okay. See, capacity, we have enough capacity, I would say, right? Of course, it would be nice to have an additional US FDA site of the Dahej size, right, also, right, just to, be very safe, right, with the way the portfolio is growing, right? But really at this point, we've done so much work at both Ankleshwar and Dahej to build capacity that we have a good 2-year runway there. So we would not be looking in the capacity space for sure, right? Unless something really cheap came along, But we'd rather spend our money to sort of enhance the platform and, create business opportunities that are beyond the current, type of opportunities that we chase. That's all the color I can give you.
Fair enough, sir. That's it from my side. Thank you and all that.
Okay. Thank you.
Thank you. The next question is from the line of Abhishek from Padmaja Investments. Please go ahead.
Am I audible, sir?
Yes.
Yeah. Sir, my question one is on that I'm looking at the presentation. So I see fixed asset turnover in FY22 it was 3.4 and now it is in the 2.5 range. Is there a reason why it is coming on and what is the number that we can issue going forward? That's my question one. And question two is, can you comment on the new platforms that you are planning to build? I remember you mentioning that was this in the past 2 conference calls. Yeah, I'm done with my questions.
Yeah, hi Abhishek. On the FATR, we have been saying in the past that while we are a part of Glenmark Pharma, the investments were not very high, and that was the reason why the FATR was that high. Now we have got into the investment phase and building capacities for our future growth. And we have been guiding to this kind of FATR going forward. And till the time we will remain in that investment phase, you will see this FATR, slight pressure on the FATR going forward as well. But we don't expect that to go below 2 at any given point of time. We are trying to manage our capexes in that manner.
Okay. So there is currently slack in your capacity because that will be used going forward because you have a strong pipeline. That's the reason why it is down as of now. Is my understanding right?
No. Look at the industry. We are still at the top of the table in terms of our asset utilization. Just compare us with anyone, right? Most companies are hovering around 2 or less than that. Even the top companies in our area, in the API business, right, are between 1.5 and 2. So, you'll have to give it to us that, we've been pretty efficient in our utilization, of capex and, because of our capacities are utilized pretty efficiently.
I'm just trying to understand the reason for the fall, sir. Absolutely, I do get that. I do get that it is high. And I look at BVs or Laurus Labs, it's pretty high and I get that, but I'm trying to understand the
You go back and look at the same 2 companies that you're talking about in terms of asset utilization, right? They are not at 2 also. Okay?
Yeah. Okay.
Thank you. The next question is from the line of Ketan Chheda, a retail investor. Please go ahead.
Hi. Thanks for the opportunity again. Doctor, I have a question on the GPL contract. You mentioned there is an obligation from the GPL side. Could you please clarify by when does that obligation end?
The obligation is for 5 years. We have completed 1 year on that. We still have 4 years as a part of the contract.
Okay. Thank you so much. Thank you.
Thank you. The next question is from the line of Abhishek from Padmaja Investments. Please go ahead.
Actually, I didn't get the answer from the second question, sir, like regarding the new platforms that you are planning.
Oh, sorry about that. See, with respect to new platforms, right, one thing that we are very clear about, right, is that we are not going to move away from the chemistry, platform, right? I mean, there are good opportunities on the biologicals and stuff, right? But we'll be going too far away, right? And then that's like running two platforms simultaneously, so that doesn't make sense. The whole idea is that when you invest money in R&D as well as on the commercial facilities, right? You want to be able to have synergy as well, so that it's not a 1 + 1 2 game. You want to have 1 + 1 to be more than 2. Okay. That's the way this business works, right? And again, it addresses the earlier thing about how much do you sweat your assets, right? So, I mean, we are clear, right, that we want to be able to, stay with the chemistry platform, leverage the, portfolio that we have built even more, right? And, basically do more with less.
Okay, thanks.
Thank you. The next question is from the line of Bharat Seth from Quest Investment Advisors Private Limited. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, earlier you said this 4 CDMO project that we are running, that is largely on life cycle management. Is that correct understanding?
No, the first 2 are specialty. The next 2, and then the third one is life cycle, and the next 2 are also life cycle.
So, sir, is that fair understanding life cycle management? I mean, the CDMO project is a more stable revenue than the kind of, specialty where lumpiness, or how should we think about it? And
okay. See, what happens in specialty is that they're breaking into the market with something new, right?
Correct.
So it does take a little bit of time, right? Okay, to stabilize the business, right?
Correct.
With life cycle, there is already a market that is. The innovator has a market. In fact, they are trying to keep as much of it with lower cost API. Okay.
Correct.
So there, they are trying to basically compete with the generics, right, on the life cycle side. So the sort of outlook on the market is more stable, I would say, okay, on the life cycle part. But on the specialty side, it's a bit lumpy, I do agree. But then the margin profile is very different, okay? You have a significant difference on the margin side, okay?
Yeah.
On the specialty.
Okay. So on second side, so there could be some price pressure every year will be there for this life cycle management product vis-a-vis specialty. Is that fair understanding?
No, I don't necessarily agree there, because what happens is usually with both specialty as well as life cycle, we have longer term contracts.
Okay.
And we also have built-in clauses for cost escalation and so on, right? That help us to retain, the margin.
Okay. And second question, sir, about this pipeline of 5-6 projects that we are there. So if you can give more color, is how much could be on the life cycle and how is the specialty side?
So right now, with 5 projects, right, the first 2 are specialty and the next 3 are life cycle, right?
Yeah. Okay.
What was the question again? What would be our pipeline?
So next, sir, the project which are in pipeline.
Oh, the future pipeline.
Yeah.
So right now we are engaged in 1 life cycle, and the project 6 and 7. It's not yet in the bag, okay, by the way. We are in advanced stages. So, but 1 is life cycle, 1 is specialty.
And so how we are developing the capability and what would be our strategy in the CDMO business? How to look at, the specialty vis-a-vis life cycle, and what will be our effort?
See, in life cycle, right, there is already dossiers that are filed in all geographies, right, or various geographies. Now, the key here is to, basically push through the variation filing, okay?
Correct.
And that has to be done in terms of, the product being similar, the API being similar to the existing API that they use. So basically, we have to mimic the API of the innovator in all ways, especially physical properties becomes very important. Okay?
Yeah.
That is one thing you have to do. But then there is also, hand in hand with that, right? What is the faster way to get through our API, into their file, and then they get the approval. So those are the challenges. Okay. Of course, you have to meet cost. I said that earlier. So the cost is done. Otherwise, you don't get selected also. Okay.
Okay.
So this is.
Yeah. Go ahead. Sorry.
And on the specialty side, basically, it's all the customization that they need.
Okay.
Yeah.
So what are the major challenges that you see current, in our generic side as well as, this whole overall major challenge, if you can elaborate 2, 3 to grow at faster pace?
Yeah. Can you come back? We'll take it.
Sure. Thank you. Thank you and all the best.
We'll connect separately. There are people on the queue and we have shortage of time.
Okay, sure. Thank you and all the best.
Thank you. Yeah. Thank you.
Thank you. The next question is from the line of Harshal Patil from Mirae Asset Capital Markets. Please go ahead.
Yeah. Thank you, sir. Good morning, and thanks for the opportunity. Sir, just 2 clarifications required. One, we said the Dahej brownfield project is basically aimed at catering to the CDMO project for largely. So, sir, once the brownfield is done, would it take some time to really start the commercial supplies for the project 4? Or, it can be immediately done? Just wanted to know if there would be any validations for the brownfield or something like that, or it can immediately start around.
No, in this case, it's immediate, Harshal. Because it's already commercial. We are sort of tight on capacity here.
Right. Got that, sir. And so second thing, just, your politics. Within the CDMO space, we've been talking about life cycle and both. So just wanted to know, in a year of 4 quarters, is there any seasonality or any demand, uptake trends from our customers that we're seeing for these 5 projects? Or it's like, it could be depending upon their production schedules. How does that work? Any market flavor around that?
There is, I would say it's seasonal. What has happened is that 2 of our specialty projects, the customers have gone for a new indication for both of them.
Okay.
And those are taking a little bit longer to materialize in terms of, having new indications. Okay.
Okay.
So this is the challenge, right? But there is an established market. They have a good footprint. It's just that the growth that we expected, right, is not there, right, at this point.
Sure.
What is there is
okay.
It's not growing further. That's what I'm saying.
Sure. Got that, sir. That helps, sir. Thank you. Thanks a lot. And all the best.
Yeah.
Thank you. The next question is from the line of Alankar Garude from Kotak Institutional Equities. Please go ahead.
So one question on R&D. If you look at our R&D in the last 2 years, especially after the change in ownership, it's increased a bit, both on an absolute basis as well as a percentage of sales. But if you look at the absolute quantum, maybe 65 crores in FY23 was at 80 crores in FY25, and maybe 21 crores as you reported in Q1. So the question is this enough to keep on growing our generics business at a fairly strong pace, and at the same time increase the CDMO contribution to that 12-15% in the next 4-5 years, which you mentioned? Or do we really need to increase our R&D even further if we have to keep on growing at that pace?
That's a very good question, Alankar. I mean, on CDMO, we will have to add a little more muscle, okay? But for generic, we are good. Okay, in fact, there has been a kind of shift internally in resource allocation for generic, where we are doing more backward integration projects and more CIP projects, right, for next-gen processes, right? Okay. While we're continuing to build the pipeline. So, I think there would be a slight uptick in terms of R&D spend, just so that we have enough strength in all these platforms, okay? And the reason why it has gone up is also because of the platforms, Going forward, I mean, I don't think it'll exceed 4 to 4.5x of revenue, right? After everything we do. Percentage of revenue.
Got it, sir. That's helpful. Thank you.
Sure.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question for the day. On behalf of Alivus Life Sciences Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.